So far, we've looked at what an exemption is, and we defined that there is such a thing as a personal exemption and a dependency exemption. And then we looked at the two types of dependency exemptions and how someone can qualify as a dependent and increase this amount. We also looked at filing statuses and indirectly at the standard deduction. Next to each standard deduction, next to each filing status, we had a standard deduction amount. So now we're actually going to look at it in more detail, and we're going to look at this whole item, because this whole item right here is 1. We take the greater of either the standard deduction or the itemized deduction. Again, the reason we take the greater is because the greater this number, the lower the taxable income, and the lower the taxable income, the less the tax will be paid on that income. So let's go back to the slides real quickly and then see what a standard deduction is. A standard deduction is an amount allowed to all taxpayers to reduce their taxable income. Now, as the name implies, it's standard. Everyone gets it. It's not something that you have to present receipts for or supporting documentation for, as compared to the itemized deduction. So in contrast, let's see. If we were to take the itemized deductions, itemized deductions are just that. It's an itemized list of deductions that are allowed, and you either have them or you don't have them. And if you have them, you need to provide supporting documentation to the IRS if you do ever get audited. But the standard deduction never has any documentation requirements to be presented, because it's just allowed as it is. So sometimes, and actually in most cases, people don't even have enough itemized deductions, so they go with the standard deduction because it's just there to be taken. So it's compared to the itemized deduction to see which is greater, since only one of the two can be deducted. So you can have either or, can't have both, either the standard deduction or the itemized deduction. So we looked at them before. For single, this is for 2015. These numbers change almost every single year, so don't pay attention to the numbers. Just know the way it works. Single and married filing separate is the same. Married filing joint and qualifying widower is the same. And then this is 2 times this, so 6,300 times 2 is 12,600. Head of household is always a different number, and it happens to be 9250. So all you need to memorize, if you do want to memorize, is the single and the head of household, because you can come up with the others. Like, we went over this in the filing status videos. This is called the basic standard deduction, so everyone is allowed this. There is an exception for dependents we're going to cover in a bit. Now let's take a look at the additional standard deduction. So the additional standard deduction amount is available for taxpayers who are 65 years or older as of the last day of the tax year, or blind. So you can get 1 for each. So you can, if you're 65 and you're blind, then you get 1 and 1. Then you get 2. Now these amounts are a little bit different, and it doesn't work the same way as the standard deduction works. The basic standard deduction works. So single and head of household is the same, which is 1550, and all the others are 1250. And again, these numbers are for 2015, they change frequently. So the single and head of household amounts are the same, and these three are the same. So if someone, let's say, was single and they were both blind and 65, then it will be this number times 2. And if they were married filing joint, then it will be this number times 2. But if, let's say, the husband is 65 and blind and the wife is 65 and blind, then it's this number times 4. So it's just, basic math to come up with these numbers. Again, these numbers do not need to be memorized. So let's get to the question of who needs to file a tax return. In general, if a taxpayer has W-2 income and they don't have self-employment income, these apply, these filing threshold apply. So this filing threshold, how we come up with is basically take the standard deduction, which is a combination of both basic and additional, plus the personal exemption amount, and we come up with the filing threshold. And if their income is above that, they're going to need to file. If the income is that level or less, they don't need to file because their taxable income will be reduced to 0 or less, and as a result there will be no tax due. This doesn't mean they can't file a return. They can, but they don't have to. So for single, we just take the basic standard deduction plus the personal exemption amount to come up with the filing threshold. This could be more again, if the taxpayer is over 65 and is blind. If you notice, for married filing joint, we have we have 8,000 because there's 2 individuals, so that's a higher number, and it just works that way for the others as well. To come up with the filing threshold, just take the standard deduction plus the personal exemption amount.